Hey, Wildcats. I wanted to do a quick review on one topic. I'm not sure how much we spent time in class on it, and it's related to the income statement. So it's a small modification. So first of all, remember our structure. This is really important to commit to memory. You're going to have your operating revenue section, right? And that's going to be, so I'll just run through the sections. It's going to potentially have your gross patient service revenue, right? Then you'll have deductions for uh, contractual allowances, bad debt, allowance for bad debt. You add all that together, you get your net patient service revenue, NPSR. Then you'll have other revenues, right? And so if this is a clinical operation like a clinic or a hospital, you'll have the gross PSR, patient service revenue, contractual allowances, bad debt, right? And that gets you to net PSR. So a contractual allowance is not an expense. Bad debt is not an expense. It is an adjustment to the gross PSR. Remember, the PSR comes from the charge master, right? And we talked about how the charge master is basically funny money. Nobody actually expects to pay it unless you don't have health insurance, in which case you kind of get screwed over. Okay, so these are adjustments. So we subtract contractual allowances, we subtract bad debt. That gets us to our net patient service revenue. Then we have other revenue. It could be typically the cafeteria, parking fees, gift shop, and there might be some other things. Add all that together, right? So we take our NPSR plus our other revenue, and we get total operating revenue. Okay, so total operating revenue. Then we have operating expenses. So I'm going to, this would be one long column. I'm going to swing it around here. We have operating expenses. Those are going to be things like salaries and benefits, right? Supplies, interest expense. Right? Most hospitals and large organizations have interest expense. This is interest they're paying. Depreciation expense, that's an important one, right? And then some other ones. So I'll just those are just common ones. So I'll add all that together. That gets me my total operating expenses. Now, a common mistake people make is they make depreciation negative because they know they know it's supposed to reduce the overall income, but it's negative just like interest expense is negative, just like supply expense is negative, just like salaries and benefits is negative. For some reason, students tend to make depreciation expense negative, and so when you subtract a negative, you know that it turns into an addition, right? And so that messes up students' operating expense total. So then you'll have your total operating expenses. You subtract your operating expenses from your total operating revenue to get operating income. And you need that number in order to divide it by the total operating revenue to get your operating margin. So it's important to write that in, operating income. Then you have your non-operating gains or losses. I put the losses in parentheses because that indicates it's a negative potentially, right? So whatever that's going to be, you add these two things together, and this is the point I want to make. In a not-for-profit, we would call this, I've been calling it net income. Not-for-profit would call it an excess of revenues and other support over non-operating gains over expenses from continuing operations. But since that's such a big mouthful, I usually just say in class, even when we're talking about a for-profit, I talk about it as net income. So if this was a not-for-profit, we would stop here and we would call that net income. Okay, and so that's and that is not wrong. That's correct for a not-for-profit. Here's the thing I want to make a point on is if this is, so then we would be done. That's the whole income statement for a not-for-profit. If this is a for-profit entity, there's still one more step you have to do. So I'm going to scribble out the net income here because operating income plus non-operating gains or losses is going to give us our taxable income. Now this is different, right? So now I'm talking about a for-profit. So everything was the same up to here. With if this was a not-for-profit, this would be the end of, this would be the bottom line. This would be the excess of revenues over expenses, basically, right? Or the net income. For a for-profit, that line becomes your taxable income. Then you have to pay taxes on your taxable income, right? So then you would take the taxable income minus the taxes, and that would give you your net income. So there's one more line, basically, that differentiates a for-profit from a not-for-profit income statement. So I just wanted to highlight that point. So I'm going to do a super abbreviated version real quick with some made up numbers. So let's say that we have a for-profit entity and it has total op revenue. I'm just going to abbreviate this whole section as one line of, let's say, 1,000, right? So that's the bottom line from the operating revenue section. It has total op expenses, including depreciation, of, say, 800. Op margin, right, would be 1,000 minus 800, 200. Okay, op margin, sorry, not op margin, op income. I'm already thinking ahead to what I want to do next. Sorry, because I want to show you op margin and profit margin. So we have operating income of 200. Let's say they have non-op gains of 50 so this would be the end, right, for the not-for-profit, and that would be 250. That becomes their taxable income. To calculate taxes, you have to know what the tax rate is. Let's just say the tax rate is 30%. So if the tax rate is 30%, the taxes will be 30% of 250. So 250 times 0.3 is 75, right? And that becomes your net income. 250 minus 75 is 175. Okay. So if this was a not-for-profit, we would have stopped here, and that would be the net income. But since it's a for-profit, they have to pay their taxes. So that's just kind of quick review. Just this one line, right, is the difference between for-profit and not-for-profit. There's some other things, but for our purposes, that's enough detail. So operating margin, right, is going to be operating income divided by total op revenue. So that'd be 200 divided by 1,000, which would be 20%. No hospitals have a 20% op margin, so just set that aside. Normal is more like 4 or 5%. Right, so they would have an operating margin of 20%. So that would be the same whether this is a for-profit or a not-for-profit, right? Because everything above here is the same. It has nothing to do with whether it's for-profit or not-for-profit. So then the profit margin for the not-for-profit version would stop here, right? Because that taxable income would actually be the net income for the not-for-profit. So we'd have 250 over the total revenue for the organization. So the total revenue for the organization is the op revenue plus the non-op gain of 50. So we have 250 divided by 1,050. That's an important point. A lot of folks a lot of students miss that point. You should be adding together the non-operating gain and the operating revenue to get your total revenue that goes in the denominator. Okay, so this would be the profit margin for the not-for-profit. So 250 divided by 1050 would be 23.8%. Okay. The profit margin for the for-profit version, you're going to now use net income of 175, right, divided by total revenues, and total revenues are still 1,050. 175 divided by 1050 gets you 16.7%. So the taxes make a bigger, because taxes come after the portion of the operations, right? They make a impact on the profit margin of for-profit entities. Okay, so that was just a quick review. So that's kind of both a quick review of the income statement, quick review of operating margin, and then profit margin, as well as taxes for a for-profit entity. So the taxes would be the difference between for-profit and not-for-profit is down here at the end of the income statement. This line would be the end if it was a for-profit entity, right? And it would be, usually it's expressed as excess of revenues over expenses. I usually just say net income because that's easier to say than excess of revenues over expenses. Either one is fine. But if this is a for-profit entity, after you've gotten your operating income and you've added in your non-operating gains or subtracted your non-operating losses, that gets you to your taxable income. Then you have to calculate taxes, right? And you need a tax rate. And so taxable income minus taxes gives you net income. Okay. And then we calculated operating margin, which is just the operating income divided by the operating revenue. Profit margin is, in the case if this was a not-for-profit, this would have been the net income. So use 250 divided by the total revenues, which is in this case the operating revenue and the non-operating revenue. So that goes into the denominator. So you get 250 over 1050. So that's it. Okay, quick review. Hopefully that's useful to you.